So again, we are so thankful everyone's able to attend the open forum on taxes for financial aid officers. Going to tell you just a little bit about Robert. We're so thankful he's here. Robert Weinerman has been providing tax training for financial aid officers for 6 years, having taken over for Jim Briggs after Jim retired after 30 years. Got some longevity going here, folks. Robert started his financial aid career in 1993 at MIT, where he quickly became the go-to guy for files containing business tax returns and for international applications. Robert worked as an aid officer for over a decade at MIT and Babson College and at several other New England colleges as a consultant. Robert is happy to be part of PASFAA, even though he lives in Massachusetts, and reminds you that he is available to answer your questions about the tax code and financial aid year-round through emails. So once again, we're so thankful that you're here, Robert, and take it away.
Thank you, Melissa, and welcome everybody. As titled, this is designed as an open forum. It's an opportunity to ask whatever questions you have. So if you do have questions you wanted me to cover, please put them into the chat. I did, as you know, as you came into the survey, or if you were looking at the session, I did create a poll asking people what they wanted to take away from this session, and I did pre-prepare answers to 3 of those. So I think I will start with one of the things that the group of attendees prioritized as one of the things they wanted to cover today. And as I do that, feel free to type your questions into the chat. Just so you know, I covered the unemployment compensation exclusion and how to treat that and how to deal with the electronic announcements from September 30th and October 15th in the other sessions. I'm happy to talk about them again today if someone asks the question, but I'm focusing on things I haven't covered yet in other sessions. And remember, we do have an upcoming pair of tax trainings through the training committee, and I'll certainly be expanding on some of that stuff there. So let's start with the one question or the one item in the poll that was most popular, and that was the $1 AGI announcement from September 30th. So the department has this habit of saying, hey, we've identified a problem and you need to do something about it, but they don't really give you the detail you need either to understand the problem necessarily or to tell you what to do. So let's kind of look at the fact that in 2020, there were steps taken by the IRS that created artificial $1 AGI tax records for people, and those tax records can interfere with the proper analysis of Title IV aid. And so let's look at the problem and then talk about the steps you would need to take should you receive an IRS data retrieval tool input with a $1 AGI. So what happened? How did this happen? Well, way back in March, Congress created an extended child tax credit with a kind of a stimulus aspect of it that allowed people to receive part of that child tax credit as an advance payment from the months of July through December. And if the IRS had a 2019 or 2018, excuse me, a 2020 or 2019 tax return on file, they used the data from that tax return to determine the person's eligibility and automatically trigger these payments unless the person opted out. But these payments were also available to people who did not file tax return in 2019 and would not file a tax return in 2020. So the IRS created a tool called the Child Tax Credit Non-Filer Sign-Up Tool. And it allowed people either to say, I'm not going to file a tax return, but here are my legitimate dependents, and so send me the money, or add dependents if they hadn't filed their 2020 tax return and had filed a 2019 tax return. If they had a child in 2020, or if the child was born after, if the child was not eligible to be a dependent on the tax return but qualified them for the child tax credit. If the IRS didn't have a tax return on file in 2020 for someone to use this tool, what they did is they created a tax record with a $1 AGI. And I believe, though I haven't been able to confirm this, that record the $1 AGI came out of a $1 interest statement. So the artificial record would have a $1 of interest income triggering a $1 AGI. And that the problem is once the IRS generates a tax record for someone, it doesn't update the basic tax data that's available through the tax return transcript system. So if someone used the child tax credit non-filer sign-up tool and the IRS didn't have a tax return on file for them, and then filed a tax return, the $1 record will be the primary record available through the IRS data retrieval tool and the tax return transcript. So someone could have filed a tax return, say in October, after having used the tool in August to get these claims. And so what I think is going to happen is the IRS has this $1 AGI tax record from which the data retrieval tool will derive the extract, or a tax return transcript will be generated. And then the real tax return is in effect an amended tax return to that transcript. I think these will generate an 07 code with the IRS request flag, though NASFA has indicated that they got information that the department doesn't consider this change a amendment to the tax return. But my understanding is that if the IRS receives a change to tax data after the initial tax record is created, we will see an 07 code. But one way or another, we have this problem that people could use the IRS data retrieval tool and it can bring in a $1 AGI, even if they filed a tax return with a more substantial income. And the two issues there are, they won't know that they imported a $1 AGI. They're going to get an ICER with a 0 EFC and feel really, really good about it. But that 0 EFC could be incorrect. Another issue that the department didn't address is if these $1 tax records exist, then our non-filers who attempt to get an IRS data retrieval tool data set, who attempt to get a non-filer transcript will get a letter that says we can't give you a non-filer verification letter because we have a tax record on file. The September 30th electronic announcement didn't cover that, but that's another thing that we want to talk about. A third thing that
if they revise their tax return,
do we have a way of, thank you, Melissa.
8915.
Hey, everybody, if you are in here, you have to.
It's problematic because people
recordings
don't
off,
save
please.
that form.
I can.
I think if we require it, we're never gonna get it.
So
And you don't have to require it.
took the pension out for coronavirus.
I wonder how many people actually did that though. There's no benefit. You still end up packing just later.
Yeah.
Okay, well,
And we really just need a statement saying that that's what they did. We don't need the form.
Okay.
And people
whoever's
get
talking about coronavirus,
Yeah.
we can all hear you.
So I just think we need to add more. If they have it, sure, we'll take it.
Mhm.
No.
Okay, I think they may have heard me. Thank you, everybody. Sorry for that. Question came in through the chat. Can we get this handout? We did confirm that the handout was posted to Whova and the conference site, so you should be able to get it. If that is not the case, feel free to email me and I can get you a copy, but it is going, if it's not obviously available to you right now, it was posted, it should be available to you. Okay, getting back to it, here's the third problem. If someone has this $1 AGI record and it comes in through the data retrieval tool, that's going to set the AutoZero EFC flag to yes. And if they subsequent file a tax return that has an income or a Schedule 1 that does not allow them to have access to the AutoZero, then the record in the ICER will be incomplete and you'll have to kind of do a process to get all of that information. Let's kind of look at it by let's kind of move forward and kind of get away from what the problem is and see what we were told and how we're going to deal with it. So this is a cutout of the 9:30 electronic announcement. We've just gotten a note, thank you, Tara, telling you where you can find this document. If you download the PDF record and open it, these are live links. So if you click on these links at the bottom here, you will be able to go right into whatever document I'm citing there. I want to see if I can grab my pointer here. sorry, 1 second. Laser pointer. Okay, so here's the link down here at the bottom. You can follow my laser pointer. So here's what the electronic announcement said. It says financial aid administrators are encouraged to identify all instances of $1 AGIs for the 2022-23 FAFSA cycle and follow up with applicants to resolve as appropriate. Schools should instruct the student and parent to obtain a record of account transcript. And this is important. They cite the record of account transcripts from the IRS to verify the $1 value is correct and make adjustments to the student's financial aid package as needed. So three things to unpack there. Number one, you are encouraged to identify all instances of $1 AGIs. That feels like a very roundabout way of basically saying identify all instances of $1 AGIs. Then you should, it says, ask the parent to get a record of account transcript. The reason we want the record of account transcript, not the tax return transcript that we're familiar with, is the tax return transcript is going to have the $1 AGI on it, but the record of account transcript will have an account transcript at top that will have the new AGI on it. So this way you know what the new AGI is. If you see a $1 on the record of account transcript, then the $1 AGI is correct. If you don't, then you know you have to do the next step, which is make adjustments to the student's financial aid packages as necessary. I'm sorry again on the voice. I don't have a way. I can see who is unmuted, but I can't mute them myself.
I'm sorry. I'm trying to get a hold of Dan. I'll get it, Robert. I apologize.
No, I appreciate that. I apologize, everybody.
Melissa, this is Kat. What do you need? I just came in.
We're trying to mute other people talking, and I don't know how to do it.
Oh, okay. You just
Because we're
hover
getting-
over there. Yeah, just click on participants, Melissa, and then hover over their line, and then you can just mute them.
Okay, as we go. All right.
Yeah, I just did a couple there, but I'm in and out of the sessions here.
No problem. As long as I know what to do, I can handle it.
Okay.
Thank
Thanks for
you.
pinch hitting today. Yep.
My
Thank you,
pleasure.
Kat. Thanks, Melissa.
Welcome.
Okay, so talked about what this means. The $1 is likely to be incorrect. It will also trigger a eligibility for the AutoZero EFC, which might be incorrect. And what you need to do is you need to go get the record of account transcript. If it shows a $1 in the field that I'll show you, then the AGI is correct. You don't need to take additional action. More likely, it will show a different adjusted gross income. If you get that different adjusted gross income, that's the accurate AGI. And that indicates that the tax record that was imported through the data retrieval tool was a faux one, an artificial one, and you need to go back to the family and get enough information. I would suggest a signed copy of the tax return so that you can complete verification with an alternative to the IRS data retrieval tool. So this is what you would get if they get the record of account transcript. At the top of the transcript, after the biographical information, you're going to get a section called information from the return or as adjusted. The adjusted gross income on the account transcript is the adjusted gross income the IRS considers valid on the day the transcript was produced. So if this had come in, a person had a $1 AGI, but this was the account transcript they shared with you, then the correct AGI is $79,092. Now, unfortunately, the only FAFSA data element that is on the account transcript is the AGI. So once you determine that the adjusted gross income is correct, you need to go and get the signed copy of the Form 1040 and the Schedules 1, 2, and 3 if you need them in order to get the tax and the other data element that might be sitting out there. Now, there's another problem, and that problem is, as I said a couple of times, if the only income on a 1040 is $1 of interest income, the person won't have filed a Schedule 1. So the Schedule 1 question will be, did you file a Schedule 1? The AGI will be $1. That's less than or equal to $27,000, which means that the application will be flagged as eligible for the AutoZero EFC. If they use the IRS data retrieval tool, it skips a whole bunch of questions. And so not only do you have to get the Form 1040, you need to get the answers to the rest of those questions. And so procedurally or process-wise, What I would do is I would get the new 1040 and I would take the verification items and put them into the ICER. Anything I can get off the 1040, I would put them into the ICER. I would submit that as a transmission to store that data, but that's not going to be okay, because if I've eliminated the eligibility for auto zero because my AGI crossed over that 27,000 mark, then I'm not going to have, if it's a dependent student, any student information. I'm not going to have any asset information. And rather than go and collect all of that from the person after I've corrected the income information I can from the tax return, effectively removing the auto zero flag, then I would go back to the family and say, hey, listen, I need you to go back in and finish the application. There was, because you used this tool, you had a $1 AGI, and we actually got information that was incorrect, but because you had that very low income, the application made some assumptions that are wrong, and there's more you need to do. It's not going to be a pleasant process, but it is a process you'll need to go through. So that's my kind of review of the $1 AGI question. So I'm just going to check to see if we've got any questions that came in through the chat. I'm not seeing any questions yet. So I'll just go on to the next question that I prepared. And that is, can we accept a preparer's letter attesting that a 1040 is correct? I get this question. I'd say this is the fourth most popular question I get. The first is related to head of household. The second is related to a 1099 income and filing tax returns. Maybe this is the third. Well, the third would be the next one I'm going to talk about, which is when the W-2s and line 1 on a tax return don't match. But the issue here is sometimes we, based on our fact that we're not supposed to be experts on taxes, but we are expected to understand who must file a tax return and what the correct filing status for a person should be, we are often identifying that it is likely someone filed their tax return incorrectly. The most common conflicting information I think we find on a tax return is the incorrect or presumed incorrect use of the head of household filing status. And so you go back to the student or the student's family member and you say, the head of household filing status looks incorrect. I either need you to kind of explain to me how you concluded you were eligible to use it, or amend the tax return to one of the married statuses. It's usually the problem. And then we can continue to process the application. And what comes back once in a while is a letter from the preparer that says, I prepared the tax return and head of household is correct. And the question is, they're supposed to be an expert. We're not supposed to be experts. Is that adequate documentation of that we can move on and complete verification? Now, this is really a department that we need to ask a question that we need to get an answer from the department on for it to have any real meaning, because I don't work for the department and it's not really a tax question, but I get it so often that I've kind of come up with my thoughts on it. And my thoughts are that the department tells us on this particular example that resolution of the conflict could be the parents refiling and submitting a copy of the amended tax return, or a reasonable explanation as to why there really is no conflict under IRS rules. It doesn't say, or get the person who made the mistake you think they make just to tell you again that it's not a mistake. And I think that when we're talking about the question of who has to file a tax return or filing status, where the department has signaled out that you are expected to understand these things, I don't think it's adequate to accept the statement from the preparer based on the fact that it's not one of the two options presented as resolution of conflicting information. So at least for who has to file a tax return and what the correct filing status is, if the tax return doesn't seem to match the information that you're expected to know in IRS Publication 17 about these two things, then you need a corrected amended tax return or a reasonable explanation as to why there's no conflict under IRS rules. And sometimes you'll get that. A really good example of when you might get that is this kind of relatively new but growing kind of income called in-home support services or Medicaid waiver payments. Let's imagine that your student's parent is an in-home care provider. Medicaid pays for them, and they live in the home with the patient that they care for. Well, that income, believe it or not, if you haven't seen this yet, is exempt from the income tax. And someone is required to, and if the state has agreed through their Medicaid program that the person qualifies, they can have tens of thousands of dollars of income that's not subject to the income tax. They do a really careful, complete and accurate application in the FAFSA, and they say that they made, say, $40,000 of earned income, but they didn't file a tax return. We're going to get a C flag of 20 on that, saying a person reported that the income that they earned is larger than the IRS's thresholds for filing, that they're a non-filer. Well, if we reach out to them and say, hey, listen, it looks like you have to file a tax return. I can't continue to process the application until you do. If they come back and say, oh, no, I don't. I have Medicaid waiver wages, or I am providing in-home support services for someone who lives in my home, and that's not taxable income, we now have a reasonable explanation of why there's no conflict under IRS rules. In that case, I'd ask them, can you send me the letter from Medicaid telling you that your wages are tax exempt? Get that, then you've got a reasonable explanation and documentation, and you can clear that C code by using C code override code 40, excuse me, C code override code 20, and the ICER will come back valid and you can move forward. So I would be real careful with accepting solely the preparer's restatement of their error, because that isn't listed as one of the options. And I do, we did get a comment here from Melissa, thank you. The preparer's info is only correct to the extent that the people gave them good and complete info. That's actually correct as well. It is possible, for example, in our head of household issue, that the person misrepresented the separation they had from the other person, or did not identify that they were married when they talked to the preparer. And so the preparer could have done what was an accurate job based on incorrect information. If you have more information, you have to bring that information into your consideration of conflicting information. Now, you can't share anything, personal information like, hey, they're married, with the preparer. I actually hope that you almost never speak to the preparer, communicate with the preparer directly. I think that's really dangerous. But you could go back to the person, the student or the student's parent, and say, hey, listen, I don't think they knew you were married, and that would change things. You need to go back and fix that. So that's a really good point, Melissa. Thank you very much. I bet, I'm going to just do a quick editorial here, and I'm going to say, I bet that this is the kind of open forum that the department would love to have, where nobody has any questions, because I'm not seeing any questions. We did just get one. I will answer, and then we'll move on to my next prepared question. Question is, can we talk to the preparer if the family asks us to? You can certainly talk to the preparer, but you cannot share personally identifiable information with them without going through the complicated process of having the person authorize you to do that. And I think that that's very risky. And it's not the preparer's application, it's the taxpayer's application. So again, you can do that, but you just have to be really, really careful not to share personally identifiable information. And that's hard to do. You go to the tax preparer and you say, and the taxpayer says to you, the head of household is correct. You can't share with them the information you have that might make it incorrect. And so I would strongly encourage you to rely on the individual and just be really on your toes if you're going to be talking to the preparer. Okay, next question, head of household question. A student got married in December of the tax year. The spouse moved in after the first of the new year. Can the student claim head of household in the year they were married, or would the living apart from your spouse be considered a temporary situation since the intent was to live together? That's a great question. That is the number one question I have, head of household with temporary absences. So Let's kind of define the situation here. The head of household filing status is a much better filing status than married filing separately. And it's also easier to file as a head of household than it is to file a married return, because on a married return, whether it's separate or joint, the taxpayer is required to report their spouse's name and social security number or individual taxpayer identification number. And if the spouse doesn't have an individual taxpayer identification number, technically you can't file a married return. And so sometimes people default to head of household, and that creates a problem. Married people can use the head of household's filing status in two and only two circumstances. Circumstance number one is they're married to a non-resident, non-citizen. And that would be a person who's not a US citizen or permanent resident and hasn't spent more than, let's keep it simple, it's a little bit more complicated than this, but let's say they haven't spent more than 183 days in the United States over the last 3 years. So if someone is not a US citizen or permanent resident and they haven't spent more than 183 days in the United States over the last 3 years, then they are a non-resident, non-citizen, and their spouse can use the head of household filing status. The second option is the couple has lived apart for the entire last half of the year for reasons that are non-temporary. And a temporary absence is one where it's reasonable to assume that the spouses will live together when the absence ends. And if someone is separated on an absence, but it's reasonable to assume that they'll move in together when that absence ends, then the absence is temporary. And if someone is away on a temporary absence, they're considered a member of the household. So in the specific question that was posted, a student got married in December of the tax year. So they weren't married for the most of the year, but let's make it the extreme case. They got married on December 31st, 2020. The IRS looks to the last day of the tax year as the day of the marriage. So they were married on the last day of the tax year, even though it was the only day were married. So they're considered married for the whole year. The spouse moved in after the first of the new year. So they never lived together in 2020. Can a student claim head of household in the year they were married, or would the living apart from your spouse be considered a temporary situation since the intent was to live together? Remember, the IRS considers an absence temporary if it's reasonable to assume the couple would live together when the absence ends. I think that when people get married, it's reasonable to assume they will live together when the absence ends. And therefore, in that particular case, I would consider it a temporary absence because it is reasonable to assume that a couple that gets married but might not be sharing a home when they're married will eventually share a home. I would extend that a little further. I often get the question of, well, these people say they intend to maintain their households as separate households for the rest of their lives and will never move in together. But the question is it reasonable to assume that they would move in together if the absence ended? And I think it's reasonable to assume that if one of them became sick or financial situation made it necessary for them to dispose of one home, that it's reasonable to assume they would choose to live together. And so I think even in a situation where insisting they don't intend ever to live together, the IRS would say, but it is reasonable to assume that if something happened, you would choose to live together. So in general, an absence is temporary in the absence of a clear statement that makes it clear that it's unreasonable. So there's another question here related to temporary absences. It's a great one. What if a spouse is incarcerated? Can HOAs be used in that case? Well, believe it or not, the IRS maintained that adult incarceration was a temporary absence, and the courts agreed with them. So adult incarceration is a temporary absence if it's reasonable to assume that the incarcerated person will move into the home of the non-incarcerated person when they are released. And so, for example, this is a kind of example I often get. One of the schools that I work with is actually a Pell Grant granting institution to incarcerated students in the Folsom prison. They're in that the experiment, they were an experimental site. They're very close to the Folsom Prison, so they have a lot of this situation going on. You have a situation where the incarcerated parent is on a 5-year sentence. The non-incarcerated parent visits them once a week and is maintaining the home as they're going to return, as though they're going to return. The IRS would absolutely consider that a temporary absence, and head of household would be inappropriate in that case. Now, the next question is, what if the sentence is 50 years and the spouse is 75 years old? Is the absence still temporary? The IRS has taken the position that duration does not create a temporary absence. And so, yes, it would be, the head of household would not be available to a non-incarcerated spouse with a 75-year-old spouse serving a 50-year sentence, because if that person is ever released, and it's reasonable to assume the place they would be released to would be the home of their spouse, then it is considered a temporary absence. Now, on this one, I would say you're not tax experts, and I think the tax court might have an opinion on some of these. So use your non-expert judgment with incarceration and make a reasonable call. I think if a 10-year sentence is probably something that you can't really stretch, but a 50-year sentence might be. The other thing you can accept is a letter from the a non-incarcerated spouse that says, I don't intend to let this person into my home when they're released. If you get that letter, suddenly it's no longer reasonable to assume the couple will live together, and head of household becomes a reasonable outcome. Okay, next question in the chat. What if there are a non-resident, non-US citizen with an ITIN number? Should they file married then? Non-resident, non-US citizen with an ITIN. Oh, great question. I understand the question. Okay, so let's take an extreme example. Let's take the fact that the person might be living in the United States to be a non-resident alien in the United States. Let's imagine that one spouse lives in the United States and is a US citizen. First person that types in their favorite country, that's the country I'll use as an example. Type a country into the chat. Real quick, somebody. Vietnam, perfect. All right, so one spouse is a US citizen living in the United States. The other spouse is a Vietnam citizen living in Vietnam. They visit with each other periodically, but the spouse who lives in Vietnam does not spend a lot of time in the United States. So they are considered a legitimate non-resident of the United States. So what are the filing options for this couple? Well, the US citizen, because they're married to a non-resident, non-citizen, if they have a child in their household, their student, they could choose to use the head of household filing status if they wanted to. They could also elect to treat their spouse as a resident alien and file a joint tax return with their spouse. But the problem with that, and the reason why head of household is preferred, is that if you're a resident of the United States, you have to put all of your income on the United States tax return. But the United States doesn't actually have a claim on this person's spouse living out in Vietnam because they're not a US citizen and they don't live here. So if that person's earning any money in Vietnam, the United States doesn't get to tax that unless they file a joint tax return with their US citizen spouse. So the consequence of filing a joint tax return as a non-resident, non-citizen is you have to report your income to the United States. And that's why we make this distinction between residents and non-residents. If someone lives in the United States more than half of the year, the position of the government is, we don't care if you're a citizen or not, you've been benefiting from living in the United States. We want you to report all your income and pay taxes to us. But if you're not living in the United States, there's really no justification for the United States to ask you to pay taxes. And so you don't have to, but the option to file a married tax return exists. So I hope that answered the question that was posted about that. The answer is, if you're married to a non-resident, non-citizen, you can choose to file a married tax return if you want to, but then your spouse has to report all of their income on that tax return with you. The head of household option exists, and if you choose head of household, they don't have to do that. Okay, not seeing any new questions. Let me take the third of the questions that I prepared based on the poll. And that question can be kind of summarized as, we collect W-2s, they don't equal the Form 1040 line 1. Do we have conflicting information? Oh, next question. Can we include them in household size? If we do we need to report their untaxed income? All right, so that question, we're getting back to our situation where our spouse is in Vietnam and one of the other spouses in the United States. That gets to the question, is someone required to report information on the FAFSA? If this couple is living apart, but living as a married couple, they visit with each other, they talk on the phone a lot, they have family Zoom calls, then from the point of view of the FAFSA, both people have to report income on the FAFSA. Whether or not they file a joint tax return, or one files as a head of household, the other is a non-filer, the other files a tax return, in our example, to the nation of Vietnam. So if you're going to ask yourself, does someone need to provide information on the application? The answer is follow the marital status based on the FAFSA definition. If you're married and living together, or you're married and living apart, but as a couple, then both of you have to report information on the FAFSA. That means we need to collect your information, whether or not both of you file tax returns or you file a joint tax return. In our US Vietnam married couple situation, if the spouse living in Vietnam didn't file a tax return, we would take the AGI of the filer and we would add the earned income from the non-filer to that AGI, and that becomes the AGI in the FAFSA. This is guidance that appears in the application verification guide, and it is very important. About 2 years ago, the department made it very, very clear that foreign earned income should be reported as earned income and not untaxed income on the application. And if you have foreign earned income and a filer married to a non-filer, then you need the earned income to be added to the AGI, so it counts in the total income and it's used by CPS to determine eligibility for the simplified formula and the auto zero. So great question there. Just be really careful about that. And the next question is, recalc taxes paid in that instance. The answer was you would not do that. If someone's a non-filer, then they didn't file taxes. They didn't pay taxes. If you look at the guidance really carefully, if you have foreign earned income for non-filer, the IRS is interested in what they call the net income. And so if someone said, oh, I made 20,000 US dollar equivalents in Vietnam, but I didn't have to file a tax return there, and then you would use the $20,000. But if they sent you a year-end statement and showed I earned 20,000 US dollar equivalents in Vietnam and they withheld $3,000 of taxes, and I don't have to file a tax return because that $3,000 is the amount I owed, then 17,000, 20,000 minus 3,000 would be the net tax. So we don't recalculate the taxes because we would be doing that based on the US system for non-US income. But if we are aware that person paid taxes without having to file a tax return, then we account for that tax payment by reducing the amount of untaxed the amount of untaxed earned income that we report in the income earned from work, and we add to the AGI. Why do so many tax experts let parent file as single when in fact they are married with a spouse living in another country? That's a great question. I can't answer why. I had a physics professor once who said to me, don't ask me why gravity works the way it does. I'll tell you how we can figure out what it does. Why is not a science question. I think that's a question I can't really answer. I don't know why so many tax preparers are willing to file these incorrect returns, but Melissa pointed out earlier that maybe the person didn't identify that they were married. But the other possibility, and I think this is a real possibility, and Jim Briggs used to talk about this all the time, is a tax preparer wants happy customers. And if you tell your married taxpayer that your spouse has to get an ITIN and file a married tax return, and that is or you need to file a separate return and you can't have your education credits, that's not going to be a happy taxpayer. So I think some tax preparers take a little bit of a gamble and they say, if I file this as single and let this person have this education credit that they can't have if they have a separate return, then I'll have a happy customer and they can tell their friends and I'll get more business. But if I say I'm not filing the tax return unless you use married filing separately or married filing jointly, then that person will go to somebody else and they won't get paid for it. I just think I think it might be either that the taxpayer didn't report all the facts, or that the risk of getting caught with low incomes is very low, and so they just do it. And I wish it weren't the case. I wish we weren't the auditors for the IRS for low and middle income taxpayers. I mean, I often think that I wonder in those initial negotiations between the IRS and the Department of Education about the IRS DRT build out, if someone at the IRS got the brilliant idea to say, you know what, since you're going to be looking at tax returns anyway, can you guys make sure that there's no conflicting information on them? And that way we don't have to audit this population. And the Department of Education said, sure, that's a great idea. That'll mean that Title 4.8 is allocated properly. But they effectively deputized you as IRS auditors for people who don't make a lot of money. And I wish this were not the case, though it is why I have a job. So I shouldn't complain too much. Okay, I think I've handled all of the questions that came in there. Let me answer this question, but feel free to continue to type questions in. We should have time for one or more questions. Okay, let's stick with your questions because the information about this is in the slide deck. If a person paid taxes without filing a tax return, we don't calculate the taxes, correct? Would you please repeat how that is recorded? Okay, yes. So if you're looking at a W-2 and someone didn't file a tax return and they're a legitimate non-filer and they had some withholding, in that case, the person has the option to file the tax return and get the withholding back. So we would take the gross income that we see on the W-2 because they're choosing not to get that money back. They owe the United States 0 taxes for the year. They're just choosing to forego the refund that they're eligible for. The difference is there are some countries like the United Kingdom and Jamaica, for 2 examples, where if people have primarily wage income, it is possible for their employer to correctly withhold exactly the amount of tax that they owe the government. And so in that scenario, they earn $20,000, $3,000 of it was withheld, and the government's going to keep it because that was what they owed. They don't have to file a tax return to reconcile that because their tax systems were built so that a wage earner can pay their taxes without filing a tax return. In that case, they don't have the option to get the money back. So the IRS wants, the Department of Education wants us to use the net tax. So from my point of view would be, if the person is eligible to get the money back by filing a tax return, then we're not going to give them the tax break because they're choosing not to get the money back. But if the person isn't going to get the money back, even if they file a tax return, then their net earned income is the amount of income that they actually have available to them. So I hope that cleared up that statement. And basically, US, if there's withholding, file a tax return to get it back. We're not going to adjust the EFC based on money you're choosing to forgo. Non-US, if that's the way your country works, we're going to recognize you did pay those taxes. We're going to do it by taking net income. All right, so what happens if the W-2s that we collected, and remember, you don't have to collect W-2s, but if they accidentally came in with the tax return or you needed them, you determined based on the W-2s for non-filer that the person should file a tax return, but the tax return that you got didn't have all the W-2 income on it, or the W-2 income wasn't reflected on it. Do you have conflicting information? I would suggest that before you jump to the conclusion that you have conflicting information, you understand that any earned income that's not subject to self-employment taxes, any wage income is reported on line 1. And so obviously income that comes in under W-2 is reported on line 1, but income that's earned and should have been reported under W-2 also goes on line 1. And income that if it's earned in another country, but would have been reported under W-2 if it had been earned in the United States, goes on line 1. And for employees who are tipped, tip income goes on line 1, even if it's not reflected on a W-2. And then there's 3 other things that end up on Form 1040 line 1. Employee benefit reconciliations. And what that means is someone had 2 jobs, for example, and they gave more to their 401ks than they were allowed to because each employer didn't know about the other. The amount that can't be tax deducted is reported as income on line 1. Taxable scholarships end up on line 1. And if someone goes out on retirement disability before their Social Security retirement age, their pension income is reported on line 1. So we have a situation where we have W-2 income, we have earned income that's not reported on a W-2, and then we have things that aren't earned income appearing on line 1. So it is reasonable that someone might have income on Form 1040 line 1 that didn't come in on a W-2. And so you could make the case that if the income on line 1 is greater than the income on the W-2s, then there's no conflicting information because we can assume all the W-2 income is reported on line 1, and then they had one of these other things, some other earned income that's not on a W-2. Now you can choose to ask what that was if you want to, but that's a choice about how far you want to take the conflicting information steps. It is reasonable to assume that there was other income that might be reported there. In fact, if you know that the other person's a student and is well aided, such that they had more grants and scholarships than their tuition fees and course related materials could consume, you could just assume that the remainder was a taxable scholarship. But that might create conflicting information if you don't see a taxable scholarship indicated in the ICER line for taxable scholarships included in the AGI. Now, I just wanted to let you know for W-2 wages, if there's a lot of wages people can receive that don't have W-2s associated with them, household employee income, it'll be indicated on line 1 with the letters HSH and the amount of it. That may not be supported by a W-2. FEC code on line 1 means foreign earned wages. If I work for a company in a foreign country that has no US presence, I'm not required to produce a US tax return for my employees, but my employees still have to report their income on their tax return. People who work for the UN, World Bank, or other non-government organizations, even if they live in the United States, may receive an end of year statement, but not a W-2. That income will be on line 1. We already talked about Medicaid waiver payments, where people are doing in-home healthcare in the home that they live, the provider lives, that's tax exempt. So this would be a reason why the W-2s don't cover all of the wages. A couple of other things, you might have a W-2 that's not on line 1. If you see in box 13 that the person is a statutory employee, here on the W-2 I'm showing you here in box 13, it says statutory employee. A statutory employee is someone who is considered an employee for Social Security and Medicare taxes reasons, but a self-employed person for income tax reasons. So if you see an X on a W-2, that's not going to show up on line 1 of Form 1040. Instead, that's going to show up on line 1 of Schedule C. You can see on this Schedule C, if it says statutory employee box on the W-2, check here. This is where the income goes. We will see the net income from self-employment on line 3 of the Form 1040, not on line 1 where wages go. And this is the figure that would end up on the FAFSA. So these are all kinds of ways where the W-2s and the line 1 can be different. Finally, sometimes people will get a 1099 NEC for non-employee compensation or 1099 MISC, which was issued until last year. And if they get that, that means the person that paid them decided that they were a contractor, not an employee. If the person who received the contractor earnings feels that that was a miscalculation, they can report their 1099 NEC Box 1 or 1099 MISC Box 7 wages on line 1, where wages go, and they can file a Form 8919 with their tax return and pay FICA taxes and not self-employment taxes. And they can tattle on their employer and say, my employer mischaracterized me, go after them for the other half of these taxes. But if you saw that you didn't have a W-2, but there was wages in line 1, and then they sent you a 1099 MISC or 1099 NEC, if you see this Form 8919 in the tax return, you don't have conflicting information because they are challenging their receipt of that information on the wrong tax form. And that would mean you would be able to go ahead. You don't have to adjudicate whether they were actually a consultant or a wage earner. You've got enough documentation in the tax return that says there's a reasonable explanation as to why this 1099 appears on line 1 and not on Schedule C, and you would be done. I think we've run out of time. Am I right, Melissa? I don't remember. I think we had 50 minutes. So I'm going to just jump to the end here. Remind everybody that if you have questions as part of my work for PASFAA, I'm happy to get them by email, and I'll try to answer them for you. I always say I can't do your verification for you, but I can certainly help you with the sticky parts. So feel free to reach out at any point. I'll be doing 2 tax webinars this fall, and I usually do an introduction to the 2021 taxes in the spring. So I hope you will join me for those. I'm not seeing any other questions, so I'm going to pass it back to Melissa after saying thank you, everybody, for joining me. I hope you found this helpful, and I'd be really interested in your feedback on this kind of concept for a session. But thank you for joining me. I greatly appreciate the invitation to participate in the PASFAA conference. I hope the rest of the conference is wonderful for everyone.
Thank you, Robert, and thank you everyone for attending. Please do remember to complete the survey after the session. It is very helpful to the speaker, gives them some great feedback. Everybody have a great day, and thank you. We're going to stop recording.